Stock Market for Beginners, Edition 2020. I'm Arno, and today I want to talk to you about how to invest in 2020 if you are a beginner in the stock market. First, let's talk about why do you need to invest in the stock market. Investing is the single most crucial thing you can do to ensure your financial future. And the sooner you start, the easier it is to get rich. The problem is that there is a large part of the population that is not taking advantage of this amazing wealth tool. People still don't understand what exactly is investing. Let's say, for instance, that 10 years ago in 2009, you invested $100,000 into a low-cost index fund like the Vanguard 500 Index Investor, VFINX. That fund will have more than quadrupled today. It is shocking how many people have been missing out on the last 10 years bulls market. The other problem is that most people don't even have enough money saved for near-term emergency or for retirement. If you want to build wealth, there are things you must do. First, you must live below your means. This means creating a budget and cut down your costs so you can save money. It's about taking control of your money so it doesn't control you. Second, you must save. This means paying yourself first by automatically diverting money from each paycheck to your savings or investment account before you are tempted by it. It must be at least 10% of your income. Third, and most importantly, you got to invest. You save to invest. You don't save to save. The most important thing that people even forget is that you must invest what you save so it can grow. That's how you build wealth. Especially today, 43% of millennials are not investing their money. And that's a problem. Most of them are saying that the stock market is too scary or intimidating to them. And that's how they are missing out on the simple greatest wealth tool, investing in the stock market. Let's see why it's so important to start investing early. Let's say we have two people, Joe and Jane, and they are both planning to retire by the age of 65. Let's start with Joe. Joe is 25 years old and he's making $48,000 a year, which is considered the US median salary. But Joe lives on a budget and he starts saving 10% of his salary, meaning $400 per month, and he invests those savings into a low-cost index fund like the S&P 500. Given that the historical 30-year return on the S&P 500 has been roughly 12%, Joe will be a millionaire by the age of 52. And by the age of 65, 40 years from today, he will have contributed a total of $192,000 into his portfolio. And his investment could be worth $4.7 million. Now let's talk about Jane. Jane is 35 years old. She makes $120,000 per year, which put her in the top 10% of the US salary for that age group. But Jane has never invested before, and she's only starting to invest in the stock market. Let's say post-tax, Jane is able to save about 20% of her take-home salary, which is about $2,000 per month, and she started investing those savings into a low-cost index fund like the S&P 500. By the time Jane is 65, 30 years from today, Jane will have contributed a total of $720,000 into her portfolio, and her investment could be worth nearly $7 million. But if Jane started investing 10 years earlier at the age of 25 years old, her investment could be worth nearly $23.5 million, which is $16 million more if she started investing early. And that's why people lose, because they want things fast when life is long. Anyone can get lucky and win the lottery. Also, anyone can pick a winning stock from time to time. But if you want to achieve lasting financial success, you need more than just an occasional lucky break. Here are my 5 tips to succeed in the stock market. Tip number 1, don't lose money. The first question that every great investor constantly asks is, how can I avoid losing money? This may sound counterintuitive. After all, most of us are trying to hit the jackpot on the stock market. This explains Warren Buffett's famous line about his 2 rules of investing. Rule number 1, never lose money. Rule number 2, never forget about rule number 1. The question becomes, how do you avoid losing money on the stock market? The most successful investors recognize that none of us can consistently predict what the future holds. The talking head on TV can pretend as much as they want that they know what is coming. Don't fall for it. Successful investors always guard themselves against the risk of unexpected events and the risk that they themselves could be wrong, regardless of how small they are. What they do instead is that they design an asset allocation, which is a mix of different types of investments, diversifying among them in such a way that they reduce the risk while maximizing the return. In other words, they seek to protect themselves against the downside while keeping the eye on the upside. Tips number 2. Seek for the highest investment return with a risk as little as possible. Most of us think that we need to risk big in order to win big. But the best investors don't fall for this high risk, high return myth. Instead, they seek to risk as little as possible to make as much as possible. This is achieved through diversification. The benefit of proper diversification is that it allows an investor to reduce the portfolio overall volatility or risk without necessarily reducing its expected return. For instance, let's take a look at this chart for the investment portfolio expected return versus the risks. A portfolio comprised of 80% bonds, 20% equity carry about the same risk as a pure bond portfolio, yet offer roughly 150 more basis points in annual returns. Further, adding foreign content or international equities, as shown on the higher curve, move the efficient frontier upwards and to the left. In other words, it reduces the risk even further while increasing the returns. Additionally, a well-diversified investment portfolio will allow you to navigate the crashes and market corrections, so you can accelerate your way to your financial freedom. Winter is coming, my friend, so get ready. Tip number 3, invest into low-cost index funds. Be a passive investor and avoid high fees. There are 2 approaches to investing: passive and active. Passive investors seek long-term gains with little recurring effort. They spend little time selecting individual securities, for instance, Facebook versus Amazon, but a significant amount of time upfront on asset allocation, such as equities versus bond or domestic versus international, etc., with the goal to match the performance of certain market indexes rather than trying to outperform them. On the other hand, active investor would typically spend significant amount of time researching company financials to find the undervalued company, that is, those that are trading below their perceived growth or their perceived worth. The goal for active investors is to beat the market or outperform certain standard benchmarks like the S&P 500. The question becomes, what approach is better? That is an ongoing and sometimes quite heated debate in the financial industry. This choice is critical for your investment results, and I highly recommend a passive approach. Active investing is generally more expensive. You need to pay research analysts and portfolio managers, as well as additional costs due to more frequent trading. Not only that, studies have shown that less than 4% of active managers outperform the market in the long run. This means 96% of active managers fail to beat the market. after accounting for expenses. While active investing can be especially helpful during periods of market stress, when outperformance is most critical for investors, in general, passive investing is more effective in the long run. Like Warren Buffett says, the stock market is a device for transferring the money from the impatient to the patient. So I recommend that you invest into low-cost index funds like the Vanguard S&P 500 Index ETFs. Tip number 4, rebalance your investment portfolio annually or semi-annually. The beauty of passive investing is that you don't spend your day looking at your stock and panicking every time that it goes down or up. You spend time upfront to create your balanced portfolio with a diversified asset allocation. Then a couple of times a year, you can go check to see how your investment is doing. I personally only check my portfolio once a month, and once a year, I rebalance my portfolio. Portfolio rebalancing means restoring a portfolio to its original makeup or asset allocation mix by buying or selling investment. The primary goal of a rebalancing strategy is to minimize the risk relative to an asset allocation target rather than to maximize the returns. The point being, over time, asset classes produce different returns that can change the portfolio asset allocation. To recapture the portfolio original risk and return characteristics, the portfolio should therefore be rebalanced. Tip number 5, top 5 mistakes that investors make and how to avoid them. Mistake number 1, timing the market. Successfully timing the market is extremely difficult to do. Even institutional investors often fail to do it successfully, especially in the long run. Instead, create an optimal asset allocation for your investment. Mistake number 2, getting greedy and trying to hit home runs. Like most beginners, each new investor thinks he's going to be the next Warren Buffett. Don't try to outsmart the market. You are fighting a losing battle. Instead, save yourself the time and money by choosing a low-fee index fund. Mistake number 3, overconfidence. This is the number 1 emotional bias that causes experimented investors to overestimate their abilities. You need to know that you could be wrong regardless of how smart you are, so plan accordingly. Mistake number 4, mistaking recent event for ongoing trend. Don't buy the wrong thing at the wrong time. Mistake number 5, getting fearful and becoming loss averse. Don't let your emotion guide your investments decision. This is why so many millennials are so afraid to invest in the stock market because of what they saw happen in 2008. You have got to get off the bench and step into the game of investing. Now it's time to act and make your first investment. Here are my top 5 online brokers to buy your first low-cost ETF index funds. Number 1, Vanguard. Number 2, Robinhood. Number 3, TD Ameritrade. Number 4, Fidelity Investment. Number 5, Betterment. Like most things in life, the hardest part is to get started. Act now. Thank you for watching, and if you enjoyed this video, please give it a thumbs up and don't forget to subscribe.